my presentation, um, of which I'm going to focus on a few different things, but really oil and then currencies and some other assets that tend to be very um, related, have a very strong connection to energy markets as well. Uh, to begin, there has been a lot of issues with Iran and Israel that have been all over the news. This table that I'm showing on the screen is perhaps what everybody is paying attention to in regards to impact in oil prices. When you think about what goes through the Strait of Hormuz, is about 20% of global oil supply that goes through that strait. And so that's certainly of a lot of relevance when it comes to the potential impact in oil supply globally. Now, this is a new chart that I'm going to show now that I think it's even more relevant that I think people are not really paying attention to. If we go to the next chart, it's not that complicated. If you look at the red line in the first panel of the chart, you're looking at Iran's oil production. If you look at the white line, you're looking at OPEC's oil production, of which Iran is part of OPEC. As you can see here, there has been times where and they're in different axes for a reason, because OPEC's production is larger than Iran's production. So I just wanted to see the movement rather than in the same scale. You can see clearly that Iran's production has been steadily rising recently. OPEC's production, on the other hand, has been basically the same level as it used to be decades and decades ago. We have not seen much of a growth in OPEC's production of oil. Iran has been becoming more and more a bigger part of the share of OPEC's total production. When you go to the second panel here, you can see that Iran's share of OPEC production is now about 15.5%. It's the largest in history of the data. And so, what is so important about this is that oil's production from Iran has arguably has never been so important. And so, certainly, what's been happening there, while everybody else is focused on the Strait of Hormuz, which is correct. I mean, I don't not saying you shouldn't be concerned about that, but you should also be thinking about Iran's own production of oil are more relevant than they have ever been, are arguably in history. And so, certainly, what's been happening there to me requires more um, attention from a market standpoint, because I think the geopolitical premium in oil prices is perhaps mispriced. Let's go to next chart. Next chart, we're looking at a Bank of America uh, chart in regards to the overweight and underweight of managers, fund managers, in regards to different sectors, and they're looking at the global energy sector in this case, and you can see that the bars, not the although the blue line, the dark blue line takes most of the attention when you look at this chart. It's really the light blue bars that look really interesting, if anything, in which shows that investors are really underweight on a relative basis the global energy sector. And so this is the stuff you tend to see before an explosive move, historically speaking. And so I think that we're we could be setting the stage here for those types of repositioning where investors go from not owning a sector to perhaps owning a significant portion of those companies, and potentially changing the relative performance, which is in the dark blue line, in a significant way, and potentially also reversing that downward trend that we've been seeing all the way back from 2008. I think even for mining folks that invest in the mining industry, when I a lot of also focus has been on recession, which rightly so. You get a recession. Although we've pointed out in multiple ways how there's a counter cyclical factor to owning mining stocks during recession that people forget in regards to how mining companies can actually perform very well during recessions. It did that in 1929, in the 70s, and even in the tech bust. But again, investors have a short memory, only look at the 2008 period. What I think it's also important is that from a mining standpoint, what is your risk? Is usually, either on the price of gold or metals, falling, which, I really don't have a view that we're going to see that in the future, but, certainly could happen. But the biggest risk is a squeeze of your margin, in regards to particularly oil prices, energy prices in general. And so when I think about this, I like to own energy equities because I think that they're not just been off the radar clearly, as pointed out in this chart. They're cheap, fundamentally speaking. But I also think that oil is incredibly undervalued relative to what's been happening in the world. So those are some thoughts about energy. But when you think about energy, immediately brings back another thesis that I'm going to talk in a few minutes here. Let's go to the next chart. You can also look at the overall energy sector relative to the S&P 500, which used to be close to over, steadily above the 15-20% mark, or close to the 20% mark, 18, 17, 18, 19, when it got up to 30% back in the 70s. And then we've been seeing a steady decline as well in that number. And now we're about 3%, of which, markets are taking the other side of it to a certain, a real extreme, in my view. If you think about how much energy the energy sector, represents for the overall economy from a profit standpoint, but also from, how much we need of oil to function the global economy. This certainly should not be 3%, in my view. And so I think that's screams asymmetry. This is why I wanted to show this. And a lot of times, you have oil prices moving up, and you start saying, well, that's the reason why you should own energy stocks. And what bothers me about those sentences is that the foundation of the thesis is right there. It has nothing to do with trying to predict what if Iran is going to bomb Israel or Israel is going to bomb. I have no idea about that. I just know the foundation of the thesis is there. The equity prices for energy relative to how much money they make is extremely cheap. It's an under-owned sector of the economy, and for all those reasons alone, it should justify at least a look over this sector. Therefore, why I'm showing in this presentation. All right, let's go to the next chart. Equal weighted commodities have been moving in a big way recently. I find it interesting that a Fed member, Chris Waller, has been very outspoken. Perhaps he wants the next chairman position when the time it comes for Jay Powell here soon, and has been very vocal speaking about potential for cuts in interest rates as soon as July. Was his in one of the interviews this morning. And I thought that was interesting because inflation is far from contained at this point. If you look at the equal weighted commodities index, it's now close to 17% appreciation year to date across all commodities. You can blame energy, but it's really not energy. It's metals, it's agricultural, and it's energy. And so across all these things, I'm starting to think inflation could start moving to the other way that the Fed wants. But also unemployment rates is starting to rise. If you look at permanent job losses, for instance, relative to unemployment rates, boy, we're seeing a major divergence there. Permanent job losses is starting to pick up in a very significant way. That to me is one of the most important indicators that tend to predict where unemployment rates could be, the next few months. And that could be a huge way for the Fed to justify cutting interest rates. I've been of the view that short-term rates are extremely high relative to where the economy is. And for those that think the Fed can fight inflation, just, 2 months, 3 months, 4 months, 5 months, 6 months, 1 year, 2 years, just, 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 1 year, just take a look at how much money we're paying for interest payments to GDP. It gets to a point where there's so much leverage in the system that you almost force at any cost to lower rates, to reduce your burden on the debt. Forget about inflation, and that's when hard assets begin to outperform. Therefore, why you're seeing on the screen hard assets, commodities, doing so well year to date, but not just year to date. They've been doing well for a while, and especially when you look at independent commodities, because when you're watching markets or investing in markets, what I find fascinating about a big macro thesis unfolding is that it doesn't unfold all at once. It does sort of like a domino effect. First is gold, and then you start seeing the miners, and you start seeing silver, and then you start seeing the currencies, and it's sort of you know uh, everything has its own order, and you never know when those orders are going to take place either. You can use technical indicators for that, but it's really difficult to time those things. But one thing that we have high conviction on is betting on history and looking at those imbalances and forcing central bankers and policymakers overall to not be able to fight inflation. And to me, that's really the center of our macro thesis here. Let's go to the next chart. Now, this is what caught my attention this week in particular. I've been looking at this chart for some time now. In the prior presentation, I showed this chart and I said, I think the Canadian dollar is getting ready to break out. And why did I have that view? I had that view because if you look at the British pound, broke out of a similar trend back in 2024. That was the first currency that I saw that caught my attention, and I was really surprised by it. And as I was developing a view about looking at interest payments to GDP of the U.S. versus other places in the world, I remember telling Kevin, I was like, well, there's something happening here in the currencies markets that are, a bit giving me perhaps more conviction that the dollar might be turning. Then the euro broke out. The euro took off and broke out a few months later. Again, a domino effect in markets. These things don't happen all at once. Then the yen did the same thing. Boy, the yen, nobody likes the yen. Everybody hates the Japanese markets, not the equity markets, the Japanese currency. And then the yen broke out. Is there anything more hated than Canadian dollar? And I can even feel the tension of the audience. In terms of there's so many Canadians that watch these shows that we put out, and I find it fascinating how many of them completely ignore the fact that you're seeing these trends breaking out. And remember, these trends of the dollar tend to be linked to the gold trends as well. So was gold enters a secular bull market, it usually is aligned with a downward trend on the dollar. So you got to be paying attention to all these things. Now, let me show you a few charts that are all sort of interconnected. I respect that interconnectivity of markets a lot. Let's go to the next chart. Well, before that, positioning, because I saw a chart from Bank of America going around that even probably my grandmother tweeted this as well regarding how the dollar is now a narrative that is crowded, that everyone is short the dollar. Look, maybe there is the case in some individual pairs in some cases, but I'm not a big fan of some of these Bank of America. Even I just shared a Bank of America chart at the very beginning. To be quite honest, it's their data. Who knows how they're calculating those things? I'm showing you a chart that is from the CFTC non-commercial positioning, and that this is real. And what I find interesting is that the Canadian dollar today is at its one of its most shorted levels in history. And so that I can tell you that positioning is really off in this currency alone. This is not a currency that is overly owned by investors. It's actually the other way around. Speculators are, historically one of its most extreme levels in terms of shorting the Canadian dollar. Now, you can say there's merits to that. Some people like to say that Canada is has lost its way and probably will never go back to a place where it's going to attract capital again. I happen to think that when things get this extreme, and you have a view on oil, and you have a view on energy, and you have a view on commodities, and you know that there is a link usually to Canadian dollar performing very well versus the dollar, US dollar, in times when gold is doing really well. Well, I like to take the contrarian opinion on this one. So I think the Canadian dollar looks very attractive as an investment as well. Let's go to the next chart. Now, look at this interconnectivity of markets. Canadian dollar versus Brazilian equities. It's the same chart, right? The Canadian dollar has been sort of, again, just broke out. Hopefully, here in this chart that I showed not too long ago. But the Brazilian market has been, doing a very similar trend. Now, let me show you another chart that sort of perhaps is leading this market in a big way. If the Canadian dollar is breaking out, I suspect that that would be very positive for Canadian assets as well, the denominated assets, like mining companies that, for regulatory reasons as well, tend to raise capital in Canadian markets. And so, as we see those things unfolding, I suspect that capital would also flow into Canadian dollar denominated assets as well. But Brazilian equities, why this link? And it's as I said before, gold is the easy market to perhaps understand. It has lower volatility. It's got a ton of history, and in central banks tend to own the asset. And so when you see central banks buying gold, for other investors, it's a lot easier to get behind that thesis as they start making money or benefiting from the rising gold prices. Everyone, as an investor, starts thinking, what's the next one? What's the next gold? And usually you start looking at or historical correlations. And the first thing that comes to mind is miners, silver, and therefore why you have some connectivity in markets. And one of them is are things that are knock-on effects of the gold price that usually are not as obvious. Canadian dollar, Brazilian markets. Why? Because they have high exposure to natural resources as well. Let's go to the next chart. Here's another interesting one. Platinum, of all metals, platinum. And Brazil is not an exporter of platinum. Why in the world? The platinum chart is almost exactly the Brazilian equities chart. The only way I can explain is the way I just explained is as we go up on the risk curve as investors, you start with gold, and then you go to the miners, and you go to silver, and then you go to platinum, and then you go to palladium, and you go to Brazilian equities. You keep going down that trend. Ultimately, the money flows down. And the same people that told us that gold would never move are now telling me as well, and Kevin as well, and Quinton, that the exploration stocks and the junior equities, or the smaller, earlier stage companies in the mining industry, will never, that money will never trickle down to those companies. I don't believe in that. I believe in history, and I think we're getting close to this. Let's go to the next one. The next chart, you can see that the copper price has also been leading the market potentially in Brazilian equities. You can see here the link as well. In the early 2000s is very strong when copper was taking off, and then Brazilian equities has started to attract more capital. And that makes more sense because Brazil does have a significant amount of copper. It has a very close relationship, of course, with iron ore and energy and agricultural commodities, but base metals is a big exposure for Brazil, and so that makes more sense. But think about that, sort of resistance line in Brazilian equities we've seen for so many years, potentially being broken out here very soon because of all these other markets already leading the way. That to me is the relevance of all these connections. Let's go to the next chart. Next chart. Now I'm going to talk about one thing that I think it's also. I don't usually talk about single name in presentations. I shy away from that because, uh, well, first I leave it to Quentin in that front. Sometimes we talk about Mag 7 names specifically, but in this presentation I'm going to mention one specific name. One thing that everybody I think should know and probably knows about it is that when you look at the price of most assets, they tend to be aligned with earnings, not only earnings, but estimates for earnings. And so what you're seeing on the screen is earnings in blue and prices in white for the Philadelphia Gold and Silver Index. And what you find here is that there's a very strong connection. When estimates go up, the metal prices or those companies tend to do very well. That makes sense, right? Well, let me show you a next chart then. Let's see the next chart here. All right, the next chart now you're showing Barrick mining, of which is in a very important technical setup. And you see this blue line showing the estimates of earnings for Barrick. It's been just going up and up and up. And at the same time, the share price has been languishing for good reasons, by the way. There's plenty of reasons been mismanaged for a long time, in my opinion. But there are times as well when the cycle, the gold cycle, can save a lot of mismanagement. And so maybe that's the case here. That's certainly my belief. If we go to the next chart, what I find interesting about the Barrick technical setup is that when you draw a line, there's a resistance on the monthly candles that we just broke out just recently. And so when you tend to see these types of setups, the same way you see with the Canadian dollar, the Brazilian equities, platinum that recently broke out. Silver used to look like this, and now it's broken out already. I think it's remarkable because usually you tend to see a momentum that tends to take place in those situations. Again, I don't have a crystal ball that's going to be the case. I'm just using history as a guide here, and I'm also looking at fundamentals that have been improving. If you go back, just go back a chart real quick. You can see that the blue line is your fundamentals in that case. That clearly is improving in a large way, and potentially, if the white line is supposed to be really following the blue line, then a major breakout would make a lot of sense. So that's the rationale behind all this. All right, let's jump to two charts now. There we go. Silver, I think this is the chart of maybe the last few years. I find this chart fascinating because it's just very close to a major breakout of a cup and handle. There's some issues with technical analysis, but I love historical cup and handles because they're usually very strong uh, tendencies that tend to be broken, and so we're really close now to the 40 handle in silver. Once we break down from that, of which I believe we will, we're probably going to get to a price discovery moment, and that's where it gets really interesting, where nobody knows where it goes. But again, we're just using a chart, looking at technical analysis. We have very high conviction on the metal. We believe it's probably the cheapest metal on earth for fundamental reasons. Silver is used as monetary purposes, but also as industrial metal too. And as money managers, we've always been looking for different ways to find exposure to silver. And so let's go to the next chart. And this is another one of those that it doesn't, I think, logically make sense, but I wasn't aware of this link that the US dollar, which is in blue, now we're looking at DXY index, so it's the dollar versus other fiat currencies, large weight in the euro and the Japanese yen, the British pound, and some others. And the white line is the gold to silver ratio. So remember what I said, that usually when you have this tendency of the dollar tends to turn uh, down when the gold is taken off. Makes sense to see this relationship between the dollar versus the gold to silver ratio. Why? Because once gold really takes off, what you tend to see is that silver takes the lead. And so the gold to silver ratio tends to contract. So if I'm a believer that the blue line is likely to fall, I by almost by definition also a believer that the white line is going to be under pressure. So that's certainly the case here. I think all of us in this presentation believe that the gold to silver ratio at these levels is truly unsustainable, and so we believe that that's going to also fall substantially here in the future. Let's go to the next chart. I'm almost done. This is another chart that I think puts into perspective how much where silver could be in terms of undervalue or overvalue. And I like to look at silver relative to money supply in one way. And this chart is fascinating to me because if you go to the next chart, you can draw a line that shows that maybe we can see a breakout from this line. Breakouts they become a lot more obvious, after fact. But I like to, I think Paul Tudor Jones has a sentence that the whole idea of investing is investing before a breakout, not after. And he is, to me, one of the smartest technical traders out there. So to hear that from him, I often hear the opposite strategy, right? You see the breakout and then you start investing. To me, that makes zero sense. I always like to find an idea that from a macro and fundamental standpoint are very compelling, and then you have these types of ideas where if you are of the view that the white line is going to break out at some point, I believe investing early is always a good idea. That's just my view in the way we invest at Kreska. But look at this other relationship. Did I remember I said this connection between different markets and so forth? Well, you're looking at silver adjusted to money supply. Let's go to the next chart. Oh no, I don't have it. Let's go to the next chart. Is that the last one I have? Oh, too bad. Well, let's go up two charts. I'm sorry. Apologies. Go back to the silver chart again, if you don't mind. The silver. Yeah, there you go. Well, I don't have the other one, but basically, if you look at the gold chart adjusted for money supply, we just saw a breakout in the gold chart that happened recently, and it's exactly the same chart, but the white line, is already above this resistance that we're looking at the chart right now, and to me, that's what is likely to happen with silver as well. My last chart is something about equity markets, of which I wanted to just point out. Global equity markets total market cap relative to GDP is at about 120% today. When was the last time we've seen this? Only one time, and this was in 2021 at the very peak of the market, when a lot of people said it's very obvious that we were in the bubble. Well, we are in a bubble now too, and nobody sees us as obvious. And so I find that also fascinating because we're well above where we were back in the early 2000s. Kevin has a good chart that shows market cap to GDP of Mag 7 companies. And the usual elephant in the room that people love to address is, but Kevin, you're just looking at a bunch of companies that have revenues outside of the US. Why are you looking at US GDP? Well, I'm addressing the elephant in the room right now. I'm looking at global market cap relative to global GDP. What's your next excuse? So there you have it.